One of the most respected men on Wall Street was secretly running the biggest Ponzi scheme in history. $50 billion in fabricated wealth, not a single real trade behind any of it. Charities wiped out, retirees left with nothing, regulators warned for years and did nothing. And somehow Bernie Madoff convinced the entire financial world to trust him with money that was never actually there. In 1960, a 22-year-old Queens native founded Bernard L. Madoff Investment Securities with just $5,000 saved from working as a lifeguard and installing sprinkler systems. Over the next 3 decades, he built the modest firm into an absolute powerhouse of electronic trading, helping it to pioneer the technology that would eventually challenge traditional trading floors. By the early 1990s, Madoff had served 3 separate terms as chairman of the NASDAQ stock market, cementing his status as one of the most respected authorities in modern finance. This immense institutional power made him a permanent fixture of Wall Street. He was an ultimate insider, someone who literally helped write the rules of the system. He and his wife Ruth moved effortlessly through elite social circles, from exclusive country clubs in Long Island and Palm Beach to the boards of prominent cultural institutions. Madoff became the treasurer for Yeshiva University and led the board of directors of its prestigious business school. Through these charitable networks, especially within Jewish philanthropy, Madoff established close personal connections to wealthy families, foundation directors, and university trustees. He was a trusted peer and a generous benefactor. This social credibility created an impenetrable shield. Investors simply believed that his public standing replaced the need for independent verification, treating his elite status as absolute proof of safety. In the volatile world of finance, market fluctuations are an absolute certainty. Yet, the private investment advisory arm of Madoff's firm seemed entirely immune to these forces. Year after year, his clients received monthly statements showing annual returns of 10 to 15%. These results were framed as steady, dependable, and completely resistant to market swings. When the S&P 500 index plummeted, Madoff's funds remained positive. When the market spiked, his returns rose at a controlled, predictable pace. He claimed his proprietary strategy shielded clients from downturns, allowing him to systematically harvest steady profits in any climate. To the untrained eye, it was the perfect investment. But in finance, a genuine performance curve looks like a mountain range, filled with jagged peaks and deep valleys. Madoff's performance chart looked like a paved highway rising at a gentle, unbroken angle. The warning sign was a pattern so incredibly stable that it defied the laws of probability. A market with zero volatility simply does not exist. By offering uninterrupted growth regardless of economic chaos, Madoff's numbers were quietly screaming that something was wrong, presenting a stark contradiction to his polished, respectable reputation. The steady returns Madoff reported to his clients did not come from the stock market. In fact, they did not come from any investments at all. Behind the quiet wood-paneled offices of his investment advisory business lay a remarkably simple machine. It was a classic Ponzi scheme, stripped of all financial jargon and reduced to a basic money loop. When a new investor handed their money to Madoff, that cash was not used to buy stocks or options. Instead, it was deposited into a corporate bank account at Chase. When an older investor wanted to cash out, Madoff simply withdrew money from that same account to pay them. The engine of the entire operation was not market genius, but recycled cash. The profits clients saw on their statements were completely fictional. To keep this illusion alive, Madoff's staff manufactured thousands of fake trade confirmations and monthly statements. They used historical market data to look back at what stocks had done, then printed trading tickets that showed perfect, retroactively timed trades. The paperwork looked flawless, complete with exact strike prices and transaction times, but the underlying trades never actually took place on any exchange. This entire structure was trapped in a constant race against time. Because no actual wealth was being generated, the loop required a constant growing inflow of fresh capital. As long as new money arrived faster than existing clients asked for their cash back, the machine ran smoothly. But without that continuous stream of new deposits, the entire architecture would instantly collapse. In 2000, a quantitative finance analyst named Harry Markopolos sat down with Bernie Madoff's public numbers. Within 4 hours, he knew they were mathematically impossible. Markopolos reconstructed the supposed split-strike conversion strategy using real-world market data. The options market simply lacked the volume to support the massive trades Madoff claimed to execute. No matter how he adjusted the math, the steady upward line did not represent real market behavior. Markopolos packaged his findings and sent them to the Securities and Exchange Commission. Over the next 8 years, he submitted multiple detailed warnings, explicitly calling the operation a Ponzi scheme. He laid out the mathematical proof, pointing out that Madoff operated without an independent clearing broker or a legitimate custodian to verify his assets. Yet, the SEC failed to investigate. Investigators conducted superficial reviews, accepting Madoff's polished explanations and industry stature at face value. This institutional complacency allowed Madoff's elite status to override technical scrutiny. Regulators chose to trust a former NASDAQ chairman's reputation rather than verify his actual trades, leaving the multi-billion-dollar warning signs completely unaddressed. In September 2008, the global financial system fractured. As major banks collapsed and markets plummeted, panicked investors across the globe scrambled to protect their remaining wealth. Suddenly, everyone wanted their cash back. This systemic panic triggered an unprecedented wave of withdrawal requests at Bernard L. Madoff Investment Securities. By early December, clients had demanded an astronomical $7 billion in redemptions. Because Madoff had never actually invested a single dollar of his clients' capital, there were no stocks to liquidate or assets to sell. The entire structure relied solely on a steady stream of new deposits to pay off older investors. But with credit markets frozen and new investments drying up completely, the money loop dried up too. With $7 billion in withdrawal demands and only a fraction of that left in the bank, the cash reserves evaporated. On December 9, 2008, Madoff realized the structure was finished. That evening, in his Manhattan apartment, he privately confessed to his sons, Mark and Andrew, that his legendary investment advisory business was nothing but a giant multi-billion-dollar lie. When the lie collapsed, the shockwave tore through thousands of lives. The damage extended far past the numbers on a spreadsheet, resulting in the sudden absolute erasure of life security. Entire families watched their retirement funds and life savings vanish overnight, leaving them facing immediate, terrifying financial ruin. The destruction quickly reached past individual bank accounts. Charitable foundations and prominent nonprofit organizations discovered that their endowments, earmarked for medical research, education, and global humanitarian missions, had completely evaporated. Elite circles of wealthy investors and high-profile public figures were similarly devastated, finding that decades of accumulated wealth were gone. While the public focused on the staggering headline figures, the true human cost was measured in the sudden loss of safety and trust. The direct net losses in actual cash reached roughly $18 to $20 billion. But the physical wreckage of the bank accounts was only part of the tragedy. For the victims, the emotional toll of realizing that their entire lives had been built on a total illusion was a burden that no recovery process could ever fully repair. Today, the illusion of safety still blinds us, proving that a polished reputation can mask absolute ruin. Decades later, we are left with one haunting question. How could one man convince the financial world that billions of dollars existed, when almost none of it ever did?